Welcome to vTalkInsight, Market Drivers Daily for August 7th, 2026. Middle East tensions are pushing energy back into the spotlight and nudging yields higher, just as AI investment and a surprisingly resilient growth backdrop keep the cycle alive. Let's look at how geopolitics, AI capex, and growth are interacting across assets today. Middle East tensions are back at the top of the macro agenda, and the stress is now visible in both energy and rates. Iran is threatening to bar United States and Israeli ships from the Strait of Hormuz, consider transit fees for countries it labels hostile, and has been linked to fresh attacks on commercial vessels. At the same time, Houthi forces are stepping up strikes in the Red Sea and Bab el-Mandeb, putting pressure on the main alternative shipping lane. That combination is tightening energy logistics without yet triggering a full-scale supply collapse. Brent crude is trading in the low 80s, with daily moves of around 1 to 1.5% on headlines, and European natural gas prices are climbing as below normal storage meets winter anxiety. Liquefied natural gas exports from the Gulf have been effectively halted by intermittent missile and drone attacks. Bunker fuel costs are about 60% higher than in February, and traffic through Suez has slumped as tankers sail around Africa instead. Even so, crude continues to flow. Several Gulf producers are pushing volumes through pipelines to the Red Sea and Mediterranean, and the United Arab Emirates is leaning on Murban barrels that bypass Hormuz entirely, sometimes on tankers with transponders switched off. In the United States, higher domestic output, temporary waivers on shipping rules, and expanded pipeline capacity have kept local energy prices below the worst-case fears highlighted earlier this week, even as global benchmarks remain volatile. For assets, this looks more like a volatility regime than a one-way trade. Energy equities and United Kingdom indices with heavy oil exposure are outperforming, while European futures are modestly softer as higher input costs bite, with Eurostoxx contracts edging lower into the open. Bond markets are watching the same tape. Recent rises in longer-dated Treasury yields are being linked to the latest oil bounce and stickier inflation expectations, and safe havens are responding, with gold up more than 6% on the week and silver over 11. The prevailing stance remains cautious on duration, favoring short-dated government bonds that offer income without the full-term risk of a renewed inflation scare. The key question is whether this new normal of sporadic attacks and rerouting becomes embedded. Watch LNG flows, bunker prices, and any breakthrough in Hormuz talks to judge whether the energy risk premium keeps building as we move on to the AI story. AI remains the dominant structural driver, but markets are now insisting on clear economic payback rather than just scale. Mega-cap tech firms report rapid returns on AI investment, in some cases under 3 years, and Microsoft's latest results showed commercial cloud growth re-accelerating as AI services scale. That supports the idea that AI capex is adding 2 to 3 percentage points to United States growth and lifting productivity, with margins near record highs and job gains spilling into construction and manufacturing linked to data centers and chips. The funding side is shifting just as quickly. AI-related spending is projected at about $3.2 trillion between 2026 and 2028, with roughly half financed through credit markets. Alphabet's $25 billion bond sale drew more than 4 times that in orders, yet priced to spreads up to 130 basis points over treasuries, a reminder that investors want extra compensation for capex risk. High-grade tech issuance has already jumped to around $200 billion this year, and heavy supply from both AI corporates and treasuries is helping to keep long-dated yields and real rates elevated, with a 10-year treasury hovering near 4.67%. Within that, some see relatively better risk-reward in high-yield AI credit, where supportive technicals and scope for ratings upgrades contrast with investment grade facing mass issuance and potential downgrades. That backdrop is driving a more selective equity rotation. In listed markets, platforms that could demonstrate clean AI monetization, such as Microsoft, are being rewarded, while capex-heavy names without obvious earnings leverage are facing greater skepticism, as Alphabet's recent equity performance and caution around OpenAI's consumer hardware plan suggest. At the same time, flows are tilting toward AI-adjacent and digital infrastructure stories like data center cooling, core networking, and cybersecurity, where companies such as Cloudflare and Gen Digital are raising guidance on AI-driven demand. Venture and private capital are echoing that move, concentrating on application layer businesses that can show real-world return on investment rather than just model complexity. The risk case is that AI becomes both the growth engine and the Achilles heel of this cycle. The current capex boom is roughly twice the size of the 1990s telecom build-out and half the housing wave, but its GDP impact is arriving much faster. A reversal would sharply raise recession odds and could reprice stretched credit, especially with investment-grade spreads already tight. Recent deleveraging in the AI complex during July has removed some speculative excess, but has not eliminated the risk of sharp swings as positioning rebuilds, particularly with volatility already elevated in AI-linked stocks and chip names. On top of that, unresolved issues around AI security, bio-risk, and fragmented regulation, from models attempting to insert malicious code to concerns over AI design viruses, mean governance headlines could inject fresh risk premia. Key watch points now are capex and earnings guidance from AI leaders, pricing in AI-related credit, and evidence that productivity gains are spreading beyond early adopters, which links directly into the broader growth story. Away from AI, the broader growth picture looks firmer than the headlines suggest, but also more uneven. Strong earnings and guidance upgrades across travel, defense, infrastructure, and selected consumer names point to a global economy still expanding at a decent clip. At the same time, much of that momentum is being driven by capital-intensive projects and policy priorities, which introduces new sensitivities to funding costs, rates, and geopolitics. In travel and consumer services, companies are leaning into demand that has proved surprisingly resilient to higher fuel costs and macro worries. Airbnb has now raised its outlook for the second time this year, citing robust United States and European bookings and a further uplift from first-time users during major events like the World Cup, with shares jumping by double digits on the latest upgrade. Budget carrier EasyJet is set to pursue a more aggressive growth strategy under Apollo's £5.7 billion take-private, while North American box office revenue and shopping center footfall are recovering as operators add more food, leisure, and entertainment to drive visits. Consumer brands such as Once Upon a Farm are posting over 40% sales growth and planning rapid channel expansion, showing that targeted niches can still grow quickly even with stretched household budgets. On the industrial and infrastructure side, the numbers are equally punchy. Defense companies like Rheinmetall are guiding to compound growth above 30% despite contract setbacks, helped by rising European and United States defense budgets, including a request from the United States Army for $67 billion of supplemental funding focused on advanced munitions. Port and logistics investment is accelerating, with large capital projects at the Port of Los Angeles, while semiconductor makers planning tens of billions of dollars of new memory fabs in South Korea are betting on sustained demand. Cloud infrastructure providers, such as Okami, are deliberately pushing capex above 40% of revenue, expecting a sharp step-up in growth from the fourth quarter, and private markets are deploying aggressively, with New York City firms alone securing more than $21 billion of venture capital in 6 months. Macro data broadly back that story. United States productivity is trending higher. Weekly earnings are rising faster than inflation, and potential GDP growth above 3% looks plausible when combined with strong capital spending, even though labor force growth and low immigration are contributing far less than in past decades. Latin American fintech and commerce platforms are growing revenues rapidly while keeping non-performing loans at record lows, hinting at structural catch-up in underpenetrated markets. The flip side is that growth is becoming more reliant on a narrow set of capital-heavy sectors and on continued access to plentiful financing. Companies like SpaceX, which aims for $1 trillion of revenue but needs roughly $400 billion of fresh capital, illustrate how sensitive some narratives are to funding conditions. With the Fed signaling that another rate hike remains on the table if growth and inflation stay firm, and with geopolitical shocks still feeding into energy prices, the sustainability of this growth pulse will hinge on how long credit, policy, and commodities remain supportive. For now, the message across energy, AI, and real economy stories is that growth is still there, but more levered to policy and geopolitics than in a typical cycle. To sum up, Middle East tensions are keeping an energy risk premium embedded in both commodities and long-dated yields. AI remains a powerful but highly selective growth engine that is reshaping credit and equity markets, and the broader growth backdrop is stronger than it feels, yet heavily dependent on capital access and policy choices. Watching how these three forces interact will be key for risk, duration, and regional exposures over the coming weeks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.